Hi everyone, and welcome to On Track. It's the 23rd of April 24. So this month, the edition has all the performance numbers up to the end of March and all the news right up to the date of recording. I'm Rob McGregor, founder and principal of McGregor Wealth Management. Before I get going, a quick general advice warning. All the information that we have in here is aimed to be useful, but you should seek advice before you act on it. That's suitable to your circumstances. This presentation is designed primarily for the clients of McGregor Wealth Management and those that use the care investment process. We're going to cover off on the latest economic news, put it into context around what it meant for the markets. I'm going to do some reflection actually on the long-term nature of the market today. It's very easy to get caught up in the short term. It's good to stop every now and then and look back and look at the big picture. And we're going to talk about the returns. We can talk about where we're at with the hottest topics at the moment, which is still inflation, interest rates. And we'll look at what's happening with property and shares. And as always, try and put it all in perspective so that we can live our motto, which is exciting life and boring money, and not the other way around. And I should point out that boring money doesn't mean low returns. It means good returns without the craziness. So let's have a look at the news. And markets have run up really strongly up to the end of March. So when we go through the March performance numbers in a minute, they're really good. But we've had about a 5% retreat, which is quite healthy. It's good for the market to pull back from time to time. Most of that retreat was triggered partially by just the markets running too hard, partly by a bit of tension in the Middle East, particularly the Iran-Israel tensions. That seems to have eased, and the markets in the last day has just started to turn back up again, which is a good thing. It's also a good thing, obviously, that the tension eased. No one wants any more trouble over there than is likely. Now, inflation, and you'll see the bottom left-hand chart here, you'll see global inflation there, the big blowout we had. So the decrease COVID, then the blowout post-COVID, and slowly coming back. But it's stubbornly still above 3%. And the big question is, does that matter? Lots of people seem to think it does, and it probably does. The Reserve Bank, the Federal Reserve, all the monetary authorities around the world prefer to see inflation in a 2 to 3% window. You'll see in the charts on the right. So when we look down, the Australian number last month was 3.4. US inflation last month actually rose from 3.2 to 3.5. So they haven't been able to quite push it under 3%. RBA cash rate remains unchanged. It's for a long time now at 4.35. 90-day bank bills are fluctuating, but they've hardly moved the last 3 months as well. They're at 4.36. 10-year government bond yields have eased up a little bit, so 4.37. That's always a little negative for markets. And the narrative there is around the expectations. So the expectations, originally we had the market run up on less bad news. That was the market pretty much accepted that rates were going to go up, and they started to anticipate the drop. Now, right at that point, markets were expecting potentially 2% total drop starting from about now. And keep in mind, this was about 4 or 5 months ago. Starting from about now and spreading over a year. The market now has factored in about 0.68% drop. So we'll see how soon and how much interest rates drop. There's a possibility they don't drop much at all and that they don't drop soon. That's because we've got this good news, bad news story, which I'll talk about from time to time, and I'll get to in a minute. We're less than 6 months to a US election. What that's going to bring is craziness and uncertainty. And it's a crazy situation. I'm not going to get into the politics of it, but it's quite amazing. The US system has come to 2 80-year-old blokes that they've got to choose from over there, and so divisive, crazy. We will see what happens. Now, on the good news front, the IMF upgraded global growth forecast to 3.2%. That's good because it means the global economy is continuing to grow, and that's always good for markets, in particular share markets. Now, the Australian unemployment rate is falling. You'll see on the right-hand chart there, the middle, the blue and the red. The rate was falling. It was anticipated to rise, but it started to fall again. Now, while that's good news for all the people that have jobs, it's bad news in that it will probably push out interest rates. Now, keep in mind, when economies are going really well, governments are not likely to drop rates. They're likely to drop rates when economies are not going well, when the economy starts to slow down. So they drop rates. Dropping rates is like an accelerator that allows it to accelerate. And that if the economy goes too fast, if it starts growing too fast, they're likely to put the brakes on, which is increasing interest rates. Now, we're in a very tepid space at the moment, so I don't see any increases. But I don't see that the drops coming very quickly. Maybe we'll get one by the end of the year. But if growth remains strong and unemployment keeps dropping, then that will possibly be put off, which is good news for those that have term deposits. And you can see the term deposit rate still holding up there, not quite 4.7, but 4.65. And there's certainly offers of around 5% still out there. But it's not so good news for mortgage holders, particularly younger, more recent mortgage holders that have paid high prices. Your mortgage rate's still about 6.15. And yeah, we've got, as I said, the Aussie dollar also stable in there. That's most of that news. So that's the news highlights. Results, when we scroll down the 1 year returns, we see some solid numbers, numbers right up to 16, 17, 18%. And the more international shares, the higher the results, the more growth, the higher the results. So our high growth core portfolio, about 17%, balance tremendous at 14%. Now, industry super funds comparable, we're printing around 9% in the last year. There's some complexities about that, which I won't go into, but results very good. And we look at our long-term targets, where for your planning, we assume, depending on the risk profile, inflation plus 3, 4, 5, 6, and the numbers certainly consistently coming in at that. And I'll put that into perspective shortly. We have brought the dial back to fair value. So we had an investment committee meeting last Friday, and at that, the market had dropped 5%, and that was enough to bring it back into fair value. Now, keep in mind, profits from companies are always going up. So the natural slope of markets is up. So expect markets to grow over the long run by around about that inflation plus 5 to 7%. And it varies from decade to decade. So there's a natural tendency for it to go up. So just the fact that markets have gone up doesn't always change fair value, because profits are rising and other news is rising as well. So as always, I love this 20-year view just to remind us of what a wall of worry that we climb. So since the GFC, where we had a crazy boom, not that any of us noticed, we just thought that was normal. And keep in mind, at the top of that boom, markets had averaged about a 25% return for the previous 3 years, Australian and US markets. So even though we thought, and we didn't even blink twice, so we've just had a 12 to 14% year in shares, and we think that's really running hot, but that's because we've got a short memory. We forget how hot things can get. Now, obviously, if it gets too hot, we get the boom goes to a bust, the FOMO goes to fear, and then we rebound because the fear is always overdone, then we slowly climb what we call the wall of worry. And let me just get some definitions in here. Any drop of 10% to 20% is called a correction. And any drop more than 20% is called a bear market. And generally, sort of above 30, you start to call it a crash. Love this quote from Peter Lynch: far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. So we make no effort to anticipate corrections. Sometimes we'll get a feel for them, but we don't attempt to trade off them because they're unpredictable in their timing and duration. And the bigger fear is being out of a market that continues to rise over time. Sometimes people get so caught up with the fear of these corrections that they miss this long-term upward slope. Now, eventually all these fears pass and we continue on with the natural growth of the share market over time, occasionally interrupted by those bear markets. Now, we've just got, it was about a month ago actually, but I'm just loading up our 2024 index chart. So it's the one you see on the walls in our office and in all our seminars and meetings. And what I love about it is it gives us a chance to step back and reflect on what is natural gravity in the share market. So this chart goes from 1950 on the left-hand side, and now it's up to the end of 2023. And you can see in that time, just $100 invested and the path it would take in the different assets. So the blue line here is Australian shares, and that's grown to 336,000 over that period at a rate of 11.6%. And you can see the asset class returns, a little table down here as well. So, and this is to the end of 23. So that 1 year return was 13%. Like I said, we all think that's awesome, but it's just a little bit above average. Now it's awesome because the 2010s, which I'll look at in a minute, we're a low decade. We always think whatever's happening now is going to be the new normal, but markets cycle and they do trend upwards. So the 30-year return at the moment is more modest, 8.6%, and that's because inflation over the last 30 years has been more modest at 2.7%. If you go back over the whole period of this, inflation, you can see back in the 70s and back in the early 50s, inflation very high. So inflation, the red line here, means that it would cost $3,320 to buy what $100 would have cost in 1950. So inflation's average 4.8%. For the last 10 years, 2.6. But for the last 3 years, it's back up at 5. So it will probably get under 3%. How quickly? Very hard to say, but it will probably get there without any other black swan stimulus type stuff. So that's the top and the bottom. In between, we've got a balanced approach. So a balanced approach, and sorry, just before I get to that. So shares, 11.6 minus inflation, 4.8. So shares, 6.8% above inflation. So it's why our target for long-term high growth, pure shares, about inflation plus 6 to be a little bit conservative, allow for reasonable fees. Balanced portfolio during that 7 years averaged 10.3. So inflation plus 5.5%. Once again, we allow inflation plus sort of 4 to 5. Once again, to allow to be conservative and allow for fees. So yeah, the message there is always, wow, look at the long-term growth. The back of the index chart, which you can see in our office as well, just in some of the pockets, has some interesting information as well. So once again, we got shares and bonds, 1950 to 2023, but by the decades. So just looking at shares, low inflation, high growth, 14% for shares. 1970s, high inflation, 10%. Modest growth, 8%. So a negative year in theory, but still a decent number. Followed by, once again, high followed by low, low followed by high. 1980s, 17.7%, inflation 8%, so inflation plus 9. High 80s, followed by lowish relative 90s, 11%. Shares, 2.3% inflation, followed by lower 2000s, but lower inflation. So inflation plus 5, so a poor decade. 2010s, the poorest decade here, 6.2%. So what we've all been lulled into now is this sense of lower returns for longer, which is probable to some degree, but we forget that low follows high, high follows low, and the 2020s may end up being one of the higher years. We will see. International equity is so important. All the blue lines here talk about Australian equities, but since 1970, you can see the various international markets here. And by the way, Australia is the lowest there. So while we're saying that's awesome, last 30 years, 10%, look at the top, and that's Hong Kong, so which is a proxy for China. And look at the difference, 13.6% versus 9%. So 4% extra compounding. And that's led to more than, look at that, 14,000 to 99,000. So this is why compounding, even an extra percent, you take Australia at 9.7, we go up to Europe, ex the UK at 10.7. So over that 30 years, that 1% is an extra $10,000. And we're talking about the growth of $100 here. So they're all spectacular, but this is why we spend so much time on the little things, trying to squeeze out that extra 1%. And it's why we are firm believers in the diversification necessary in global shares and not just having Australian shares. Bonds, pretty stable. You can see now there's a long-term view down the bottom. We've got the Aussie markets on the left, US on the right. We're talking 10-year bond prices down the bottom, and we're stuck now in this little band. We've got a little bit higher, a little bit lower. The blue line at the top for both Aussie and US here is where we are at the moment. The green dots are 1 month ago. The orange dots are 6 months ago. So we're sort of hovering in a range that's not going very far at the moment. And we're bond, and keep in mind that natural relationship. 10-year bond prices go up. Generally, growth assets will go down. 10-year bonds go down. Growth assets will go down. But we think bonds now have a good place in a portfolio to be providing 4% yields. And if the economy got weaker, that would lead to interest rates drops, which would lead to a capital gain. If the economy got stronger, bond rates might creep up a bit. So that might be weaker capital gains and more like capital losses on bonds, but share markets would be hot. So we think it's in a good place in a balanced fund now to have the appropriate amount of long-term bonds. So as usual, I've talked about the wall of worry. I won't go into any more of that today. I will say that once again, the dial is back at 7. We're thinking fair value. I've updated from the latest index chart all the downs, and I thought I'd sort of throw in the lines here. What goes down must go up, just to reverse the thinking. And of course, what goes up probably comes back. The old saying, what goes up must come down. But in the share market, the line is not flat. The line is upwards to the tune of the growth. The long-term growth of the markets. So what goes up, comes back every now and then, but in the long run, it keeps going up. And you can see here the top downturns since 1900, so that's the last 125 years, and the least bad one, 21%, the worst one, 51%. So there's one at 51%, one at 48%, and then we drop. And this is the top to bottom downturn. So this is what we're worried about, the red dots. But in all cases, when you look at the next decade that passes, they fill in the red dot and then continue the path upwards. So once again, a good reason to have a look at the long-term perspective. And it's the antidote to what I've highlighted this month. All of a sudden, market's a bit jittery on a few short-term issues, wars, etc. And throughout that long-term chart where we looked at from 1900 or even from 1950 through, there's been so many skirmishes, so many wars, so the economies keep ticking along. But we do get panicky, when I say we, the markets, not us as care investors, when these things comes along. And that's why it's so important for us to be vigilant and understand the natural tendencies we have. Behavioral bias. So this one I've got what is possibly a new one to you, but it's a framing bias. And this is where the information we get, depending on how it's presented, can lead to different judgments. So it's called framing. And the good example here is in option 1. It says here in quarter 3, our earnings per share was $1.25 compared to expectations of $1.27. So that sounds bad. It came in less than expectation, versus the same person spinning that could have said in quarter 3, our earnings per share were 1.25 compared to quarter 2, where they were 1.21. So so what the message is here, we've got to be careful about the spin that is put on. We see this in politics every day. Some news comes out, one side will claim it's good news, the other side will claim it's bad news. So they're able to frame it in different ways. And it is just data. And any news from time to time is just little steps in a much bigger picture. So message from all this, volatility is inevitable. When we talk about our 4 pillars, personalized planning, learning from history, we've just talked about, but I'd highlight it today that volatility is normal, inevitable, totally unpredictable. It's the only certainty in markets that they will fluctuate. That means we've got to manage our behavior and avoid those bad decisions, make good decisions. And when we've got all that covered, we can then get smart about the right structure of the portfolios, which is the asset allocation, diversification, and regular rebalancing. So let's do a quick run through the markets. Aussie shares, so VAS, the ASX 200 up about 14% over the last 12 months. That's to the end of March. You can see it's come off. You can see I've crosshaired the end of March there. So we're off about 5%, but that only takes us back to about February. So still a good, healthy position. And hopefully it runs again from there. You see the top 10 shareholdings there, no change from BHP, the banks, Wesfarmers and Goodman Group and Woodside Energy. So not much change there, but good diversified exposure and vast differences in returns. The worst return of the top 10 was Woodside in the last year at 7%. The best was Goodman Group at 32%. And you look down the averages, it's probably about that 14%. So diversification always incredibly important. US shares, a spectacular year, 34%, largely driven, as we've talked about, by the Magnificent 7, and you can see them in Microsoft, Apple, Nvidia, Amazon, Facebook, which is Meta, Alphabet, which is Google, and all still flying. Well, not all flying. Apple's had a 1-year return that's actually steady. Warren Buffett owns Apple these days, and these top companies, by the way, have so much cash. that they're actually got a little bit of defense built into them. They have more cash than some countries have, that they've accumulated as a backup, which is good and bad. It's obviously not earning as much as they can earn, but it sort of adds a bit of security to those big guys as well. And as I said, long-term returns there are consistent. You can see that growth of $10,000 growing to about 44,000 over 10 years, which is quite spectacular. And no sign of that slowing. US large cap is still, it seems to be a solid place to be. It's going to be the benefit of AI, automation, and the natural flow of where technology is going. So just back up, US small caps, 20% for the last year, so extremely good. Lower over the 3 years, you can see that's what we've come out of. It's still spectacular in the long run. It's also pulled back, and you can see that from the top of March there as well. Emerging markets, a much better year, but still the 3 and 5 years are pretty ordinary. But we see that everything comes back, 9.31%. When you look at the companies here, there's a couple of observations. These are big tech companies as well. They're just not domiciled in the US. You got Taiwan Semiconductor, which manufactures chips like NVIDIA, different but similar. Samsung Electrics, familiar with the phones, just like Apple, but just different. But the PEs here are lower. So these companies are cheaper just because where they live. Tencent and Alibaba, look at these PEs, 14 and 7. That's because they're in China. So there's this perceived sovereign risk, but you're getting more bang for your buck. And potential for that to go up if that perception of the sovereign risk of China goes down, and it may not. But yeah, potential for up there. Gold, always the canary in the coal mine. Gold's now been really spectacular over 3 and 5 years, 13.5% for the year. It actually went up for the last week or two while shares were going down, just because that tension always leads to gold going up, and it's a critical part of that active portfolio to keep it there. Our property, we have different but similar, same but similar. Boom, bust, boring. I was reading a good anecdote. It was a comment on someone's blog actually, and it was obviously a long-term investor that said, yeah, the story, if his property lifetime was stagnation, all the short-term investors get out. Stagnation. Even some of the long-term investors get out. Stagnation. Oops, we just boomed. And that's where the long-term investors are rewarded, both in property markets and share markets. And I thought that was a good analogy. Looking at capital cities, and we see that in the middle column, and we get houses year on year across the country. Sydney 10%, Melbourne more modest. Melbourne's introduced a land tax. Well, so they haven't introduced a land tax. They've lowered the threshold for land taxes down to 50,000. So every property in Victoria that is an investment for someone or not their principal place of residence is now attracting land tax. So that's put a brake on Melbourne. That may represent good buying opportunity. For those of you that haven't watched, refer to an email sent out or on our YouTube on an interview I did with Philip Almeida from Performance Property, and they have some of the best data that I know, where we talk about all these things. Brisbane is rock solid, 15% right now. It and Perth at 20% have been the best performing states. Adelaide as well. So the smaller capital cities. Sydney rock solid though, still at 10%. And none of this looks like changing. There's still a massive shortage. When we look at the headwinds and the tailwinds, I haven't changed this, but I thought I'd cross off some things that are less of an issue now, but we've crossed off one on each side. Consumer confidence hasn't risen. It still may rise, and that'll help property prices, but it's still stubbornly low, and that's probably because of all the news out there. As I said earlier, unemployment is actually dropping. So that, while being bad, so a rise in unemployment is bad for properties because it means people can't pay rent or mortgages, and it puts it, but it's actually falling. So it's good news for property. Like I said, it might be bad news for interest rates. Everything else on this list still stands as the drivers. So the things that are making property go up: continued population growth, high replacement cost of buildings, massive shortage of dwellings to fill up from the immigration and the natural growth we've got, and rents continue to rise, which makes it more attractive to investors. But the headwinds, the things that may make it slow down the growth or make it shrink, affordability, it's just more expensive to buy. That seems to be a fact that is just stuck there at the moment. Still some chance of a slowdown. I did cross out recession. It would be very unlikely to see a recession from here. You can never rule anything out, but that's crossed off a bit. And interest rates, as you'll see in the next slide, still exactly where they were, no changes. So still perceived to be high. For many of us who've had mortgages for years and years, they're quite low, but we got trained very quickly into 2 and 3% mortgages. So all of a sudden 6% seems really high. Historically, it's low, but if you took your mortgage out 2 years ago when it was 3% and now you're paying 6%, it does seem incredibly high, and that's hurting young people in particular. And then the last one there, strong savings built up COVID is still being spent, and we see that in our retired clients. They're happily spending money back to travel, etc. And that's good for the economy, and it's good for property as well. Almost no change to this. We're now starting to just drift across, flatlining, waiting to see what the RBA does next. The next move should be a down, but like I said, it's not happening in a hurry. Maybe it happens by the end of the year. Time will tell. Quick look, and I've stayed on Heron Todd White's property clock. I'll go back to performance property clock next month, but I find just a bit of variety in our thinking is always good. And you'll see there's plenty of places in Australia where that market's still rising. And that's a mixture of capital cities, Brisbane, Melbourne, etc., Perth, but also some of the regional towns. And there's somewhere it's declining. Most of the declines are where they've had substantial increases and just coming back to a bit of normalness. There is not one market, as much as Perth sits here as one market or Newcastle sits here as one market. There's multiple markets within the markets. So as always, get help on these decisions if you need it. We've got some wonderful contacts in the property industry for whatever the dilemmas that we have, and they're very good at helping us help you make good decisions. In summing up, as always, we have a core belief that investing is best done as part of a real plan. That's with your goals first, and your goals should be based on what's important to you, what a good life looks like to you. Portfolio designed to meet those goals, where we take a long-term view. Get down to the boring stuff then, diversification, appropriate asset allocation, enough liquidity to ride through. And low cost for most growth markets, where we minimize fees, which means we maximize the return of the markets without trying to be stock pickers or trying to be too clever, which we know is very hard, generally impossible. We protect against that short-term volatility with the reserves for our retired clients and dollar cost averaging for our clients still investing, and rebalance to take advantage of that volatility. That means we constantly trim and top up, and we do that on a regular basis. And that last reminder, there is only 3 ways to lose money, and that is panic and sell, have to sell, and not properly diversified. Once again, we and you, our clients, have a wonderful track record of not doing any of those things, which means we get to sit back and enjoy these periods like this where the wind is at our back and the market goes up. We know it will have the odd squall, but in the long run, it wins. Thank you for listening. I do appreciate your time. I know you've got lots of better things to do than listen to me on all this stuff, but we find I know many of you find it valuable just to keep that perspective that isn't the news. So that's me for the month. Look forward to catching up soon and talk to you next month.